think that where we're headed right now, with all the debt that's coming due government-wise the next 2 years, that the Fed will probably have to lower interest rates quite a bit on the short end to really take the interest cost that's coming due. In other words, if you take what's going to refinance just the next 2 years, call it 15 trillion, and the rates would go up a lot. Right now, we're spending 25% of the receipts that come in from taxes just on interest. So you imagine what happens. That's one thing. Second thing is stocks are priced very, very expensive. And for us, and to answer your question, we have a very mixed, but you'll see where we own industrials, we own a lot of energy, we own healthcare, we own utilities, it's a mix. We own some gold miners too, but in two of the strategies, but that's how we structure around that. But the biggest thing we own is short-term liquidity, which is a safety valve for us.
Hello, everyone, and welcome to another edition of CEO and Market Expert Interviews. I'm your host, Lucian. Some of you know me as Triangle Investor from social medias. We are joined today by Ted Oakley, founder and managing partner of Oxbow Advisors, author of 10 books with more than 40 years of experience in investment industry. Ted, welcome to my show. You are a well of knowledge. Great to have you here.
Lucian, I hope to be of some benefit.
Definitely will. Ted, I would like if we can start with your views on the financial markets post-election. I saw one of your interviews where you highlighted a record stock market exposure. Are we seeing the final days of this 15 years bull market? I mean, we are in a 15 years bull market, and is the 2025 year where we will see things changing rapidly?
Well, Lucian, it's always hard to know exactly the timing on these things. You can only know when things are priced wrong in terms of risk. And that's not to say it doesn't go on a bit longer or maybe a lot longer. I doubt it, but it could. But I think when you look at the pricing today of the U.S. markets in particular, the U.S. markets are very, very expensive right now. They're as expensive as I've ever seen them. And I've been around, going on 50 years almost. But so you're in a situation now where everybody's in, and they love it. Nothing bad has happened to them in the last 24 months. So we're sort of brain dead right now in terms of I used to say back in 98, 99, everybody's drunk, and we're back like that again.
So we are in a drunk phase. Okay. But Ted, are we maybe entering the phase of long trading war between the United States and other states, BRICS countries especially? Do you believe that things will maybe settle down in the meantime?
That's a hard question for me. I don't know how to answer that exactly, other than the fact that, what the incoming President Trump is saying is that he wants to, put on large tariffs. Who's to say whether that's a negotiating tool? He would actually do it. And if you look at the people that we import the most from, it's not China, it's Mexico and Canada. So you have some situations that will probably change. But I think a lot of the emerging market countries and a lot of foreign countries are sort of tired of the U.S., the last 20 years, basically beating them down, using the dollar as a hammer on them, confiscating funds and things like that. And so they've had a lot of those countries basically turn against them. And I think that if I talk to my friends overseas, that seems to be part of what they're feeling right now.
Yeah, you're right about that. Ted, what are the biggest red flags in the economy? And among those, which one presents the biggest problem? What is the elephant in the room, so to say?
Well, there's probably numerous ones, but the biggest thing is the stock market, because prior to the last 25 years, particularly the last 15 years, I should say, the economy, basically the stock market would reflect the economy. Well, what's happened and particularly the last 10 years, and because of the Federal Reserve and the fiscal policies we've done and everything, it's all to get the market up, okay, the asset side. So now the economy reflects the stock market. It's reverse. And that means people are spending money because their stocks are high. They're spending money on their children because their stocks are high. They're flying their kids places with them, buying new things. If you go look at the spending, it's coming out of the market. In our opinion, it is. It's not coming from the economy because everybody's feeling great right now because they've had their assets are so high. The real estate really hasn't gone down that much, so they feel good about that too. And so it's one of those things where, it's back like 1928 or 29. The theme was happy days are here again. And it's sort of like that. People are not thinking much about risk and they're just spending money. Well, that's the biggest threat. You get a break in that of any significance the last 2 years or something like that, and you'll change the entire economy because that's what's driving the train right now.
Yeah, so in your opinion, we could see really in 2025, I will not call it a market crash, but we could see a market correction in 2025. And actually, my question is, let's say if we see that scenario, how can average investor prepare himself for that bad times and preserve capital or even make money on the way down?
Well, it's harder for the average investor, Luciana, because they are not in the business of shorting and that they don't really understand that real well. But if I were the average investor, what I would do, and the best hedge really on those kinds of things is just to raise liquidity. And a lot of people say, well, you can buy this strategy or that strategy. But for the individual, the best thing for them to do is to raise liquidity, buy some short treasury, short term, less than 6 months or a year, and just have a safety valve so that and maybe it doesn't happen. But that's how you have to invest in this atmosphere, is you have to have a safety valve, and you ought to be looking for really good values. And that's one of the problems today, is that we have an entire group of people in the industry that, I hate to say it, but they're fairly incompetent, the people that have been around the last 15 years, because they don't look at private companies, the individual companies. They don't look at individual bonds. They just buy a bunch of ETFs and indexes. And so when the markets break or things get cheap, the only thing they will know is that price. It's just a number for them. And so they know nothing more than just to sell it. And that becomes a problem in the marketplace itself, because you have very few people today that understand how to buy a business that produces cash flow. We buy in our company, we buy companies. We don't buy the exchange traded funds, or we don't buy the indexes. We buy companies. We know the companies that will pay us the most money the next 10 to 15 years, and we'll buy companies that pay us a lot of cash flow, but we know what we own. That's entirely different what's out in the marketplace today. You've got every CFP and CPA and insurance person and trust department and all the brokerage firms. They really don't know what they're buying, other than they're buying a line item that says it's this sort of ETF. We're going to buy you 12 of them, and if they work, we think it's diversification. And if it works, and we think it will work, that's how they think, okay? And we're totally different from that.
Yeah, that's very interesting. When you say you're buying companies, what sectors are we talking here?
Well, you'll find for us right now, let me just say our biggest holding right now is the Treasury. We have 3 strategies, and all 3 strategies have, just on average, they have about 50% in short-term treasuries. By that, I mean less than 18 months. We don't know what's going to happen with the interest rate things. We think that where we're headed right now, with all the debt that's coming due government-wise the next 2 years, that the Fed will probably have to lower interest rates quite a bit on the short end to really take the interest cost that's coming due. In other words, if you take what's going to refinance just the next 2 years, call it 15 trillion, and the rates would go up a lot. Right now, we're spending 25% of the receipts that come in from taxes just on interest. So you imagine what happens. That's one thing. Second thing is stocks are priced very, very expensive. And for us, and answering question, we have a very mixed, but you'll see where we own industrials, we own a lot of energy, we own healthcare, we own utilities, and it's a mix. We own some gold and gold miners too, but in two of the strategies, but that's how we structure around that. But the biggest thing we own is short-term liquidity, which is a safety valve for us. And not because we wouldn't buy them, Lucian, but because if we screen companies, we have 250 companies we screen. If they're too expensive, we just don't buy them. And most of these companies today, good companies though, but they're priced too expensively. And so it's not a thing that will give us a great return. It's an interesting phenomenon in the U.S. market, Lucian. If you take investors that invest in real estate and private businesses, oil and gas, they always look for cash flow. There's so many things they would not buy if they didn't have the right amount of cash flow. They'd never buy those things. But yet they'll go into the marketplace, stock market, and chase price and buy things that have very, very low cash flow and sometimes no cash flow. So it's interesting to see what people do and how they think relative to those investments, relative to the stock market.
Yeah, you mentioned gold, that you hold gold as well. How do you see gold going forward?
Well, one of the things people think about, Luciana, is they realize, are starting to realize that the foreign central banks, okay, are saying, hey, look, we're going to back more and more what we do with gold. We don't really trust the U.S. government. Obviously, when this started back with the Russian confiscation of that money in the SWIFT system, and they're basically like, hey, if you can do that to them, you can certainly do it to us. So we're going to gradually try to get away from there and trade in something else if possible. Now, that doesn't mean they can 100% because you've got to trade with a dollar in a lot of cases. But I do think that if they put tariffs on these countries and really put the press on them, that they'll probably buy more gold than they're buying now. We'll see about that, but I just think gold is still undervalued. If you look at it relative to, we look at it as a currency hedge. That's what we think it is. And if you look at the gold miners, they're cheap relative price to cash flow. They're very cheap still, even with this move.
Yeah.
So I think that's what people probably underestimate, and people are real shaky right now because they've had a little selling. But when you buy gold, you have to be a long-term person. If you're going to own 4 or 5% of it, whatever you want to own, you can't trade it like a stock. It's a different kind of animal, and so we'll see what happens. But that's what we think.
Yeah, agreed. And especially on the central banks, China is buying again. They have reported buying more and more gold in November, continuing where they left off in September. Okay, Ted, what about silver? How do you see silver as a monetary metal? It is not just monetary, it is an industrial metal as well. What's your take on silver?
Well, we own some silver itself, but we own it at a lower level. We don't own as much of that as we own gold because it's much more volatile for us. It is, and it usually catches up with gold, and when it does, it goes a lot higher. And that's why we don't own as much. It's more volatile now. We own a silver company as well, um, but not as much as we own in gold and gold miners for sure. Now but we own companies that go after copper and go after iron. We really try to stay. One of our strategies. We're exposed to commodities because we think commodities are really, really cheap.
Yeah, one bigger, larger macro question. How do you see the future of monetary systems? I mean, with the world's largest economies, of course, current consensus is that the current financial fiat settings are not sustainable at this shape and form. How can we change it? What's your take?
Well, that's a really tough one for people to have to answer, Lucian. But here's the thing: most of the countries that we do business with, their debt to GDP is really high. Okay, and you can't, and if you look at 25 years ago, Germany was a country we could always depend on, for example, that had it together, ran the right kind of money, did the right thing. And then they really got messed up when they joined the EU because they bought into all of that liberal money situation, and that's really messed up their economy now. So you have a lot of the European countries, and then a number of the Far East countries too, where debt to GDP is really high, and it's really high in the U.S. And there's two ways you can do it. You can't use austerity because what happens is you'll throw yourself into a real depression because if you cut back all of a sudden, and I think you will see what happens in this administration with wanting to cut out a lot of things, and it will have some shocks to it. But the other side of it is that most of the time in the history, if you look at it, they inflated them. Most countries inflated their way out of it, so that if you look at it, what happened is the interest rates stayed higher. I'm sorry, the inflation stayed higher than the interest rates. So what happened is you end up deflating the dollars. So you're paying it off 15, 20 years later or so with lesser value of a dollar. In other words, you just inflate yourself out of it.
Yeah, yeah. Ted, is the commodity super cycle still in play, and what commodities could be top performers in the years to come?
Well, Luciana, I don't know. I can't answer necessarily what would come in years to come. I would say this: if you go back and look at the Bloomberg Commodity Index, if you were buying a stock, you would buy that today. You would say, well, it's been a long time since that really got up and ran away and that sort of thing. Now, for us, we own the metals. Again, we own silver, gold, the miners. We own, a silver company, but we own two fertilizer companies. We own some copper. We own some other metals, and then if you look, we own energy, a lot of energy, because we think, even though it may have some short-term situations that will change it somewhat. Everybody says, well, if we go into a recession, it will weaken. It will, but there's so much going on in the Mideast right now that I think people forget to factor in the fact that anything there that changes at all, and it will really impact the price of oil. So we've got exposure to oil, we've got exposure to natural gas. So we feel like we have good exposure all the way around. And that's how we do the commodity side for sure. It's not like the whole portfolio is like that, but a good piece of it is, probably 30% in our one strategy.
Yeah. Any exposure to uranium?
We don't have, and it's not because uranium can really move around on you a lot. It can get these big moves. There's a lot of talk, a lot of people right now looking at small nuclear reactor companies that could be used for for day-to-day or corporate or whatever. And I think that's probably eventually something that'll happen. It's too early in the stage for us now. And so uranium, all those precious metals probably will do well. That's not one we own, but I mean, uranium, platinum, a number of those things will probably do okay. It's just not one that we own.
Okay. Ted, what about what asset classes should we avoid in the long term? Do you have any that you really think we should avoid?
Well, if you look at technology today, it's highly owned by everybody. Very, very expensive on anything you want to use to look at it with. It's very, very expensive. And usually when these correct, they give you large corrections, not just small ones, but big ones. And I think since everybody's in that area, that when they go to come out of those and maybe go to industrials or metals or materials or something like that, that what will happen is they'll sell those down pretty hard, just like they did in 2000 to 03. I mean, the NASDAQ 100 lost 85% of its value. It's a lot. But everybody was caught up in it, and I think they are caught up in it now. We're not as high on the financials. I mean, they may do well, but you have to realize that a lot of the money they make is either from trading the market or that sort of thing, or investment banking. And the other side they do is on the true banking side. And while short-term interest rates going down would help them, what's happening is if you have a slower economy, just, hey, my spreads are better, but I don't have anybody to loan it to.
Yeah, you touched briefly on real estate. I want to hear your take on the housing market and the insights of the housing market. What are you hearing and seeing?
Well, you have two segments on it, Lucian. You have multifamily apartments, and then you have residential, which is so-so. And in residential nationwide, you have some spots where it's okay. Oddly enough, like Connecticut or somewhere like there's different places where it's really doing okay because they were sort of late to the party anyway in some respects. But all the hot markets that were before, and I'm talking about the Southeast, Southwest, Midwest, they're not as good as they were in residential. And so you're seeing people drop the pricing. And, it'll be interesting to see because we'll be coming up on 5 years pretty soon of those really, really low interest rates on mortgages. And for families and that sort of thing, there'll come a point where they get large enough. I'm talking about the families. They're young, but say they had two little ones. All of a sudden now they have three. They're big and bigger. They're going to be sort of forced to try to move into something differently. And one of the things today that people do, and I've lived through this, by the way, so I can tell you from 1970, 77 till basically 83, I watched interest rates go higher and higher and higher. My first home was an 18% mortgage. And so it's reversed now. Now the price is too high. You could have a 6.5% mortgage and do okay, but if you look at the pricing, that means your taxes are too high, your insurance is too high. So that whole thing throws the market out of place. Now on the multifamily side, I'm talking about the commercial side of apartments. We're seeing different things. We're seeing a lot of what we call direct lenders that are selling things really cheap that they had to take back. This is not CMBS, like commercial mortgage-backed securities. These are people that had a direct loan to an apartment complex. It's not working. Now you can show up and buy it for 25 cents or 30 cents cheaper than you can build it. Well, that part is starting to show up, okay? And we're starting to see a lot of bankruptcies on the multifamily side. There's a lot of stuff going on there, but it's different in different markets. I mean, if you take a market like Raleigh-Durham or certain markets in Florida, Orlando, Tampa, places like that, certain back out west, they're doing okay in multifamily. But you take markets like Austin, Nashville, Kent, different places like that, it's not good. There's too many, they built too many units. And so it just depends on where you are.
Yeah, I think that is the case all over the world, depends on the places. Quick return to the mining companies. Which jurisdictions do you prefer when it comes to the mining companies?
Well, obviously, we trade the large miners. If you look at our biggest holding, which is Agnico Eagle, we prefer situations where we wouldn't get in trouble with one mine being too large, particularly like Canada, and the U.S., certain parts of South America. I'll give you an example too. If you look at Franco-Nevada, which I think is a really fine royalty company, but they've been under pressure because the one mine got closed down and they can't get that thing going again. It was 20% of the revenue. So we try to stay away from things like that. But if you look at our holdings, if you look at Newmont, you look at Agnico, and you look at we own Royal Gold, another royalty company we really like. That's sort of the way we don't get down in the smaller companies. Number one, because we don't do the research on them. It takes a special person to know that business, and that's not us. But the large miners are cheap, and that's what we look at a lot, are the large miners, and because we have a lot of money, so for us to come and go, we can't have a little bitty miner, even if it's a good buy. We can't have a good miner. A little one will not work. We can't get in and out of it. So unless we want to buy the whole company, and we don't want to do that. So we really stay with the larger names, if possible.
Yeah, tell me, Ted, how can investors reach out to you and tell me how can we get a copy of your newest book?
Well, our newest book, which is called Second Generation Wealth, What Do You Really Want for Your Kids, will be out, but it's probably about 6 weeks before it's finished. But they'll be printing and a lot of things go on, and I think it'll come out in about 6 weeks. It'll be interesting to see how it goes. We have a little different opinion about how you ought to treat second generation wealth. So that's that to look at. We have a lot of books though. If you come to our website, which is oxbowadvisors.com, you'll see actually we have 11 other books, and you'll see different topics that we write on. And Lucian, our books are only about 150 pages because we don't think people will stay with it to read 400 pages. So we write it for what we think is the business person that will read it on a 2-hour flight, 3-hour flight. And that's how we approach it. Whether that's the right thing or not, I don't know. A lot of people get them, so I guess they like it.
I believe so, and I look forward to read the newest book. That was Ted Oakley, founder and managing partner of Oxbow Advisors. Ted, I want to thank you for coming to my show. Great chat. Learned a lot as always. Thank you very much.
Lucian, thanks for having us.